Hello, international finance students. We're on week 4 here, so we're quickly approaching the halfway point of the course. Again, you'll make sure you get your test turned in tonight. And for this coming week, week 4, you're going to have your first paper due. I think your undergraduate up to like 9 pages that include the works cited page as a page. And if you're a graduate, the additional pages. So make sure to get that in by the following week. We also have a brief forum discussion. This week we look at chapters 7 and 8. Look at international parity conditions and discussion more when we get to the concept of use of derivatives, futures, options, swaps. So this reading this week can be a bit technical. So read it slowly and take your time and kind of make sure you're understanding a lot of the examples that they have, because you'll probably see that again in test questions coming up. Again, you have to read it slowly because sometimes how things are presented, whether it's dollars for euros or euros for dollars, to make sense of what they're giving in the examples. But starting off with the international parity conditions, the idea in theory is that if goods were easily tradable, that if something was really expensive, say in Canada, all the Canadians would come down to the United States, buy it down here cheaper, and ship it up to Canada. Well, if all of a sudden there's a shift in supply and demand between the two regions, it should eventually equal out into one price, and that's kind of what it's saying with the exchange rates. If you saw that a currency was really expensive and European goods were expensive, more in the world will want to buy American goods, and as more people want American goods, it would push up the price of the dollar. So it should get to one price, but we know that doesn't happen. So there's definitely differences in the values between currencies. Like right now, for example, I think in Japan, you could only get maybe 70 yen per dollar. It used to be almost like 100 yen per dollar. So for an American going overseas to Japan, it's going to cost them a lot more. But interestingly enough, we have a lot more Japanese students coming to the United States because when they convert their yen to dollar, they're going to get a lot more. So just some highlights from these chapters. Again, with this idea of interest rates too, they do point out with the international Fisher effect, essentially with any nominal rate, you should anticipate some inflation. So the real rate and the quick and dirty is the difference between your nominal rate. So if you have an 8% stated interest rate and you expect inflation to be 3%, your real rate is only 5%. So those engaging in foreign exchange, the expectations of what the future price for those currencies should be based somewhat on interest rates. If investors were to engage in arbitrage to say switch one currency to the other, invest in a European account and earn a higher interest rate, well, again, this kind of this idea that we should equal out an equilibrium of what we base on interest rates. But again, there are other risks associated with investing overseas too. There's political risk, and there's always the risk that the price of the exchange can fluctuate too. So when we convert back to dollars, it can be expensive, or we can get a gain from it. All right. Well, things I want to wrap up with the last chapter, so just some insights from that chapter 8 with foreign currency derivatives and swaps. For the M&E, the multinational enterprise, obviously they're going to be concerned about future costs associated with anything with exchange. If I have to pay euros in the future, if I need to buy euros to buy a product. So I'm concerned about these fluctuations in prices. Well, some of the tools that we can use to kind of reduce this risk, they mentioned the idea also about options. Options would give the M&E a right to buy a currency in the future at a certain strike price or sell. So if I am in an M&E and I make sure that I need to buy euros in the future, I'm going to do a call option on euros. It means I'm going to have the right to buy at a certain price. So like we saw the market close at $1.31 for the euro on Friday. Well, maybe I'm concerned that the euro keeps going up in price, so I might have an option to buy the euro at $1.35 3 months from now. So the person that wrote the option is hoping that the price does not go up beyond that, and the option would expire and be worthless. But I'm protecting myself. And vice versa, we could do a put, which is the right to sell. So I make sure that I get the right amount of dollars I want. You could also engage in forwards, which is a specific contract that says it's guaranteed to deliver at this price in the future. But a lot of parties may also engage in what are called futures contracts. So futures contracts, you're basically taking a position which way you think the price is going to go. And if you bet right, then you're going to gain from that and profit. And you have to establish a margin account with the Chicago Mercantile Exchange or some other board that will engage in futures contracts. But the value of that futures contract is going to change on whatever that future expected strike price is going to be. So if you were to buy a euro futures contract, basically you're betting that the price is going to go up. And if you were to short a futures contract, you're selling, you're betting that the price is going to go down in the future. So the main thing though for an MNE or anyone engaging in the futures trade is that you have the underlying security. That you know that you're going to receive euros, or you're going to know that you're going to have euros in the future. So if you don't do this for hedging purposes, you're purely speculating, which is a tremendous amount of risk. In fact, that's kind of what we saw in week one with Citibank. They were speculating, and that's where the London whale got in a lot of trouble with the off-balance sheet activity. So with that, kind of wrap up for the week. And again, send me an email if you have any questions. I also want to mention, you do have the homework problems due too. But I'll continue to jump in there early in the forum discussions, get those done. But do email me, and otherwise have a great week.